Welcome to the Dividend Talk podcast, episode 135, our German dividend stocks watch list. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavor. And don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ, how are you, buddy?
Honestly, I'm quite exhausted after a week of work. It's been really, really busy, and I believe it will be next week equally busy. On top of that, all the earnings this week and massive dividend hikes. So I'm looking forward for the weekend. I think that's the right thing to say. Tell me, how about you?
It's been a long couple of weeks with earnings, and we're still only touching some European companies. So you need to rest up. It's been quite a few weeks, but it's been a good week for me. Work is work. Looking forward to this show. Actually, we're diving into some of our German dividend stocks. So we're going to try and do this with. I mean, we're Europeans, aren't we? So we have lots and lots of different countries around. So we're going to try and pick maybe once a month, maybe once every 2 months. If people like this, try and pick some stocks in certain countries. So Germany was our first one. So I'm looking forward to seeing your picks and some of mine. But before that, let's talk about the news of the week. I did mention we are still in earnings season. I know we've done 2 episodes of it, so to do a third one on the TROW would have been quite exhausting, I think. But one company stood out for me this week. I don't know if you've got time to look at any earnings, but have you heard of Ingredion before? Ticker symbol
No.
INGR. Really nice company. Some good dividend growth, and they are seeing some tailwinds now. So they have. I think you like them. They have like this specialities segment that's really grown really strong. From they're trying to reduce the amount of sugar content. Obviously, corn is gone a little bit expensive, but without that, you've seen that they can pass on this cost to their customers and some. So some really nice growth, and it's one on my watch list. And honestly, I'm thinking about pulling the trigger on these guys this month.
Nice one. So you should definitely also maybe write a post about it or something like that, and then I'll read it up as well. My head at the moment is just spinning with all the company names that I've been reading and seeing passing by over the last 2-3 weeks, because Europe is huge, right? I mean, we're talking even about the German stocks here, and I did a dump of all the tickers on the German stock exchange, and there are more than 3,000. Of course, the majority of these are international listed company, also with a listing in Germany, but it just tells you how many stocks there exist in this world, right? So I'm looking forward for that. No pressure.
Well, I'm trying to work on YouTube as well, so I'll probably do a YouTube video. Might be quicker and faster,
Okay.
and I have to hone my skills on that as well. And the only way to do that is to push out some more content. So we'll see. I won't do it this week. I know I have one plan for this week, but maybe next week or the week after, I might do Ingredion.
Yeah, so
Um,
people should definitely follow you on the Dividend Talk YouTube, right? It's a YouTube that we created like at the beginning of the podcast, because we were streaming some of the podcast shows also on YouTube. We noticed that less pickup because of the format not matching the channel, but now you started putting a lot of YouTube shorts with quick updates and some videos. You did a portfolio review. So guys, if
yeah,
you're not subscribe chat to Derek, then look at the show notes here. We'll make sure that we put the link in the description.
yeah. I mean, the podcast is not always suited to it, so I'll try and maybe even rehash some of the content with a little bit more visual. But look, I'm playing with it. We'll see how it goes. I'm new to it all. It's a steep learning curve, but we'll see. But moving on, Disney. I was laughing when I seen this week, because last week we got a listener's question around Disney, and I remember their long-term plan as a dividend investor was to hold on to Disney, and we didn't quite laugh, but I think our feedback was dividend. Disney is not a dividend company. I would not hold them if you're looking for dividends. And then within 7 days, boom, they are going to reinstate their dividends. So we got that completely completely wrong. But I don't know how I feel about that. I think management seems a little bit lost. I know Disney streaming is not as strong as they'd hoped, and I know they're trying to push that, but a lot of people are going back to Netflix and all other kind of channels. So I think it's a bit of a strange move. Personally, I don't think it was needed. I don't think they should have cut it in the first place, but now that they cut it, I don't think they needed to bring it back. So
Yeah.
it's a bit of a strange one. But yeah, hey, look, we don't get everything right on this show, and this was one we certainly got wrong last week.
Yeah, and I'm surprised by that because Bob Iger stepped back in, right? And you know, and by the way, what you said is streaming. I can see it now with my kids as well. They don't stick to the to Disney Channel, Disney Plus. They like watching with us the old stuff, but the new stuff they go naturally to Netflix. I think it's more tailored towards them, and I think Disney still needs to get their content production back to the level where it was. Yeah, so they are used to blockbusters, but Disney Plus is not enough for those few blockbusters per year, right? We watch maybe 5 to 10 hours television all with the kids, so they need to produce that much content continuously for these generations. I think that's where it feels like they are behind compared to Netflix. And I also noticed that today was in the news that Bob Iger mentioned that everything is on the table at the moment for Hulu because they earn a majority stake in Hulu as well. So I think Bob Iger is really cleaning up the house there, at least trying to. But there are just two things that I understand. Why don't they yet have streaming video on sports? I mean, on sports like ESPN, because they started with some second grade things. But now we have in Europe Viaplay, and I'm watching Premier League in Poland on the Viaplay, and then also Formula One will be on Viaplay. Yes, I think they're entirely missing the boat there over here in Europe when it comes to sports distribution. And secondly, I don't understand, therefore, really why they come back with the Disney dividend. I don't see it's needed. Maybe they're, again, doing it for the retirees or something like that, but I don't see a need for it.
Yeah, I mean, I don't know. The share price has been under pressure, hasn't it? Maybe they think this will bring back all the dividend growth investors that they lost. But I think you make some good points, particularly around ESPN. I personally would believe that has more growth prospects than Disney Plus. I believe. I mean, I think you hit the nail on the head. They don't produce enough content. We have short attention spans, and the generation below us have even shorter attention spans, and they constantly want new and shiny things and new content. And I mean, it's great. We have a lot of nostalgia towards Disney programs, but how many times are you going to sit down and watch them? You're not going to sit down there every week even to watch them. So I think ESPN is probably a better option for them. But hey, look, let's go. Personally, I'm not getting back in on Disney. They had their chance with me. They blew it, and I'm gone.
I've the same. Maybe in 10 years from now again, but for now, I'm staying away.
Yeah. And we're going to talk about one of Microsoft's competitors, which is Google. And they tried to come out with their demo on AI. I think it was called Brad. What kind of a name is Brad for an AI?
Bard.
A Bard. That's even worse.
That's how I would call my ugly brother.
It sounds pretty close to a name that's not quite nice over here as well. So, but I mean, it was a disaster, wasn't it? It was a real disaster for them.
Yeah, they lost 100 billion on a day in share and market cap. And you need to know it's because of competition from Microsoft and OpenAI, right? So Microsoft also started implementing things in Bing here, and we will get a really new search experience. As a tryout, I switched this week entirely from Google Chrome to Microsoft Edge and Bing, just to try it out. And I must say, I'm liking it already a lot. The search, for me, like I search a lot on company info and such, right? That's what I use Google a lot for. But on Bing now, on the right side, I get already a lot of data. presented to me via the AI, which I actually pretty much enjoy. So I wouldn't be surprised if I'm going to stick to this search engine Bing. And just the fact that I'm saying this is already something, if you would ask me a year ago, I would have never imagined saying. Yeah, so, and I think this is where really Satya Nadella is really, for me, like, he deserves a statue, because he started with this whole mantra of let's not be the old Microsoft, right, and push everyone Windows to the trove. He started really looking at the ecosystem, fixing problems for developers, for the whole developers community, and with that they plug in Azure, and that has been their growth driver. Now OpenAI is valued at $29 billion, I believe. Microsoft wants to invest about $10 billion, and Google is losing $100 billion on a day in market cap just because a demo of Bart went wrong. It shows you that we are having a search AI war going on right now.
Yeah, you tweeted about trying to use Bing, and I said, never, you'll never get me to do that, because anytime I've ever used Bing, you type in what you're looking for, and you never find it. I actually only ever use Bing to go to Google.
Yeah.
But just before the show, I typed in something, two quick things. One was build me a meal plan, and it gives you, like, as you said on the side, detailed, like, AI based one, and then it gives you all the search results. So it looks like it can actually compete with Google, which is something nobody would have assumed 12 months ago. So it'll be interesting to see. And as we said, all your PCs come built with Microsoft Edge. It'll be faster, it'll be optimized for it. So it's not much to actually transfer from Google Chrome to Edge and stuff. So it'll be interesting to see how this goes. AI is really going to change the landscape here.
Yeah, and they say one bird doesn't make a summer yet, right? So we need to realize that as well, of course, here. But the fact that it's giving this first impression, for me, is really mind-blowing. And if they really build up from here, it tells you what mode really means. Yeah, because often people say, like, Google has a white mode, search business, advertising business. But if this can happen, let's say overnight, then it has a limited mode. Yeah, there are just certain switching costs, but Microsoft might be able to blow it away. Let's see. It's really early day. It's in a hype now. Maybe it dies as quick as it arrived. But for now, it looks promising.
Yeah. Okay, let's talk about some dividend hikes and cuts this week. We've had quite a few. Public Storage hiked their dividend by 50%. I know. I mean, I think that's the first time since 2016, which gives them a 5-year CAGR of about 8.4, which sometimes can be a little bit misleading when you look at it like that. Waste Management announced a 7.7% dividend hike. Waste Management have been popping up quite a bit on Twitter and social media lately, so it's well followed, and it's a nice hike for investors. TROW Price, you have a video and a post about these guys. We know we both like them. They raised by a disappointing 1.7. I think the general consensus was this was expected. Nobody expected the double digits that was going to happen. I actually thought it would be a little bit higher. I was hoping for around the 4 or 5%, but it was
the same
1.7. VF Corporation cut its dividend by a whopping 41%. I don't think that was too much of a surprise either, let's be honest.
No, I did a bit of a long thread on that on social media, right? And I found the dividend not safe, so I was not surprised. Simply Safe Dividends, by the way, had still a high score, and they didn't see the dividend cut coming. But credits to them, they really said after that, like, okay, we made a mistake here, and we'll take our learnings. And that's what I like with those services. No bullshit, honest, builds credibility, right?
Yeah, I mean, look, you can't be right all the time. You can look at all the data, you can look at the history.
Exactly.
The management there is a little bit rudderless at the minute, and they're going through a bit of a transition. So to give credit, I did tease them on Twitter, only because we got a comment before about we should be embarrassed with the amount of dividend cuts we had. But to be fair to that service, you can't 100% call these. So kudos to them. L'Oreal from France hiked their dividend by 25%. Wow.
Yeah, this is like we spoke enough about it, right? Lipstick.
Yeah, it's, I
Yeah,
mean,
you know, when there's a crisis, the women need lipstick, you know, to look good, and when it's summer, they want to have lipstick to look good.
exactly.
So
Lipstick sells as we can
yeah,
see. Um, Adidas, I don't think they cut the dividend, but they've forecasted some pretty bleak
yeah.
outlooks. But Tool Group from Sweden, it's quite popular within our own community. It's been spoke about quite a bit. They cut its dividend by 29%. I don't think that was expected.
No, no, I also analyzed them and they look pretty okay. And specifically their growth strategies. So they don't have a reliable dividend historically speaking, but I wouldn't have expected a 29% dividend based on the metrics. So I have not read into the result, but there must have happened something there quite quickly. I'll do that later, maybe this weekend. Yeah. Yeah, and then
And then,
also Pepsi 10%. They raised the dividend from $4.6 to 5.06, 10%. However, they're having now a payout ratio on their free cash flow of more than 100%. So and plus a buyback announced. While I enjoy the 10% hike, I'm not so happy with this. I rather would have seen just the 3 or 4%. Everyone would have understood. And secondly, don't do buybacks, you know, pay down your debt.
yeah,
So I'm a bit in disagreement here with management.
yeah. And Unilever kept their dividend flat. Actually, we forgot to mention them. I kind of I don't know if I expected to be flat. I wasn't expecting a huge increase, if anything, and we know that they're under pressure. So it'll be interesting to see what the new CEO, what his policy is going to be going forward.
Yeah.
Uh,
Yeah.
I have to say it's a little bit concerning. I'm not quite sure where the dividend goes from here.
Mhm.
And then the last one I have was actually sent in from like Collector, the Dividend Days on Twitter, and it's about, I'm going to try and pronounce this, okay? But it's Unipol Gruppo, and I believe they are an Italian insurance company, I believe. They increased their dividend by 23%, which gives them a 7.5% dividend yield.
That's an amazing yield, right? So sounds like a company I need to look up one day.
Cool. So we might move on then to our stock picks from Germany. We pick three each. And what I'll do is I might just tell you a little bit about how I picked my company. So
Sure.
there's no real in depth. I didn't go through 200 annual reports because it would have took me absolutely weeks. So I created a simple process for this. Okay. So the first one is I wanted the 5-year average dividend growth rate plus its current yield to be above 8%, which is typically what I want to see anyway. And that that actually got rid of some companies like Siemens, Siemens Healthineers are in there, and Henkel. I don't know if you're aware of Henkel, but they're like a
Yeah.
consumer staple. So it got rid of companies like that, which I was expecting Siemens to at least get past my first round. They didn't. Okay. Then I went to, because there was a lot of companies to get through. So I tried to whittle it down. So I said I'd do the same, but over a 10-year period. And then this rejected companies like Fresenius Medical Care, and what's the other one? Deutsche Bank as well. Okay.
Yeah.
And the last one then is I just removed, because I was still left with a few companies. I removed all lower yields. So I picked like it, because I had so many. I think I picked 3% as my low point. Typically I wouldn't do that, but just for the purpose I did. For this I did, and it got rid of companies like Puma, which is interesting. So that left me with about 6 or 7 companies. I had Munich RE was there, which I expected. Allianz was there, which I also expected. Volkswagen, BMW were there. Fresenius was there. But I eliminated those companies purely on the basis I expected you to pick Munich RE and Allianz, right? And then Volkswagen and BMW, I said, car manufacturers have, particularly German car manufacturers, have such a shitty reputation.
Yeah.
I'm getting rid of these. And it left me with about 4 or 5. And then I picked 3. I think I picked the highest dividend yields from them.
But it's still interesting that Volkswagen over the last 10 years met your screening criteria?
Volkswagen and BMW, and I have to say I was tempted to put BMW in here as well, because remember we spoke about the self-driving car and
Yeah.
what they're doing over in America. So I was thinking about doing it, but I honestly just said, look, it was just in. Do you know what? There was no real thought behind it. It was like, I need to cut down companies. This is an easy reason, so I'm cutting these companies out of it. So
makes sense.
but that left me with my first company, which is BASF. And BASF happened to be one of the top companies in my portfolio, not by choice. Is a little bit by choice, but I used to do a lot of options, as we said. And then when I got assigned these guys, I actually said, you know what? I'll hold on to them. And in turn, they've turned out to be, I think, top 3 or 4% in my portfolio. Relatively small portfolio in size, given what I have. But just to give a little bit of background about BASF, they are a multinational chemical company, headquartered obviously in Germany, founded in 1865. And actually, what's interesting to note is the 3 companies that I've picked, they are all founded in either the 1800s, and one of them is actually in the 1400s. So they're really old, solid companies that have been around for years, which is good. BASF operate in over 80 countries worldwide, hire 117,000 people, and they're in 6 main segments. So you've got chemicals, materials, industrial solutions, surface technologies, nutrition and care, and agricultural solutions. It's actually one of the companies I cover on Sure Dividend as well. So I can't give too much away about my thoughts, because I write and get paid for it. But what I will say about them is that they are quite cyclical, which we know. It's an industrial company. They have cut their dividend back in 2009 or 2010. But since then, they've really put a focus on dividends, and they've put this into all their, so online, when you go onto their investor relations and you go in through their annual reports, they're really saying, now, we know we cut a dividend in the past, but we're actually valuing that now, and our policy is to increase this dividend every year. So that's actually our policy now, which is something that I like. And they try and do that. They try and create value through this concept they call Verbund. And basically all that is that trying to produce higher value-added products, chemicals, particularly in their new plants in China and so on, while driving costs down. So that's how they try and do it. As I said, there's a lot of macroeconomics that come into a company like this. We know the Ukraine war was around, that had an effect. But once the price of oil is high, this company tends to do okay, which is why we've seen them perform well over the last 2 years. Why are they an attractive investment? Well, they tell you this on their website. So they tell you their unique Verbund concept gives them a competitive advantage based on integrated sites. Industry-leading innovative platform. I think that's just plain generic stuff that everyone says. It doesn't really tell me anything. They are focusing on Asia, which is something I do like, and they do say this a lot. So we can see this with the plants that they're building in China. They're really tackling Asia, and I see some good growth there. And obviously they're trying to cut down their carbon management, which is going to appeal to our ESG investors. Looking at how they passed my screener, they have a 6.43% starting yield, which is quite high and quite attractive, and couple that then with a 5-year annualized growth rate of 2.53 and a 10-year annualized growth rate of 3. So they typically grow their dividend 3% a year. That's what you can nearly bank on, but it's that high starting yield, I suppose, that gives you that return. Looking at
I would like to correct you, by the way, because in
Go.
the last 10 years they didn't cut the dividend, right? So they had increased the dividend every year, except for 2020 when they had a flat dividend.
Yeah, they cut it back in 2010. I think I said they definitely. cut
Okay,
it before.
sorry. Yeah.
Okay. No, I'm going to listen back, but I'm nearly sure that they cut it in 2010. But since then, since 2011, they've really focused on that. And they have kept it flat. Their depth is quite good. Cash flow is quite good as well. And I think the dividend is safe. It is quite cyclical, and they have cut it before, which is the worry. But I think their renewed focus on it has me kind of confident this company, and it's a company that I'm happy to hold, actually.
Yeah, and the share price went really down, of course, because of the Russian invasion into Ukraine. They didn't know what the energy prices would do for their facilities, right? To produce the materials that they need to produce, and also the impact of their Russian holdings, right? But I
Yeah.
think so far they've been dealing with that really, really well, and I'm really eager actually to just learn what their earnings will be in the end. Yeah,
Yeah.
not sure when they will be released. Should be anytime
20
soon.
24th of February. I'm waiting on that
Yeah.
one as well.
Yeah. Okay. A nice pick. I mean, I'm like you. I'm quite long on BASF and happy shareholder here. I didn't buy more in the low 30s because I owned already quite a large position. So,
Yeah.
although, it was really tempting to buy more. It was really tempting, but I've got my rules that I need to stick to. So,
I
nice
mean,
pick.
I have them at a nice price. I think my yield is closer to 7.5 on these guys, and then with a 3% growth rate, which is quite a good
That's
return
nice.
for
Nice.
me.
Yeah.
Yeah, so it's interesting. But I am certainly tune it. Well, I have to because I write about these guys. But I can't wait to tune in and see how they've performed through the full year. But given their last 3 quarters, I'm expecting a 3% increase in
Yeah.
growth. I'm expecting increase in earnings. So
I think
yeah,
€3.5 it will be from 340 to 350 if I
yeah,
look at their tradition 10 cents. Yeah.
that sounds reasonable. I do have a fair value, and this is my fair value. Do not base it on me.
Yeah.
Of around 60 euro. So they are trading at in around 49 to 50 at the moment. So there's a little bit of upside there as well, I hope.
Nice. 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 Good. 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 So thank you for BASF. You mentioned already a little bit like EDGI, Allianz and such, but I actually didn't pick Allianz this show because I also did my research. I just made a dump of all the stocks, looked at which companies have been not cutting their dividend in the last 10 years. So I did something similar, but I didn't look at just at the CAGR, the compound annual growth. I looked at like literally no cut in the entire 10 years. And the first company that I picked out is actually Hornbach Holding. If For our listeners that are outside of, let's say, Germany or the Nordics or Netherlands, Czech, Switzerland, and Austria, because that's where they are located, it's like Carrefour. Sorry, is it Carrefour? No, it's Castorama, the French version. So this is your German Home Depot. And what I really like about this company, because I've been shopping there already since a teenager, let's say, and it's has always been the best kind of how you say do-it-yourself business for me. You get everything there, even the commercials. It's like for real men, so you really get that feeling also when you're in the shops there. And I think it's the biggest or the largest do-it-yourself store chain in Europe. What's probably good to know is that 37.5% is still owned by the Hornbach family. And this is also what I like. I always like when there's a large family ownership because you usually have more like long-term perspective than with those companies compared to the CEO that is really looking at the quarterly basis and quarterly performance. Now, if you then look at Hornbach itself, it currently has a market cap, I believe, or at least I believe market cap of 1.3 billion, but let's say a small market cap they have. And what they have been doing, just their sales in the first 9 months last year, the first 3 quarters last year, because we don't have the full year earnings yet, was up around 10.4% compared to the or 6.7% compared to the year before at is it 5 billion sales now? And also what I really like is that their online sales is really rapidly growing at the moment. And this is something also really good because I think this is where there's a lot of future with these stores as well. Because, if you order it saves you your own car and damaging half your car to put woodwork in there or something like that. I just don't know how well the operating margins are. I didn't do a full analysis on Hornbach, so I kept kind of to the screening and initial analysis. Their outlook for this year is low double-digit percentage decline in adjusted EBIT due to inflationary and cost pressures. And that's maybe also why there was a big share price drop in June last year. I couldn't really figure out why it was. I hadn't got too much time to totally look into it, but that's what happened last year. So I think some shareholders might have been scared there at that time. But yeah, the business seems to be growing. A little bit of decline then in EBIT, which I think is normal with inflation. The question is how much they can pass on going forward and how much they can recover from that. But there's a lot to like. I like their balance sheet. They have like a long-term debt of, I believe, 1.5 billion, but then shareholders' equity of almost 2 billion. So for me, that's a really healthy balance sheet for such a company, right? These are slow-growing businesses. They usually are a bit more with debt than other kind of companies. So yeah, there's a lot to like there. What maybe is not too much to like is their dividend policy, because what I don't like is if they are really explicit in their payout rates in their dividend policy when they connect it to the payout ratio. So what they say, the company aims for a payout ratio of 30% based on the consolidated net income, and to ensure that the dividend at least matches the previous year's level. So that's kind of the escape clause that they still have. But what it resulted to is that in the year 2017, 2018, 2019, and 2020, it paid €1.5 in dividend. Just the last 2 years, it went from 1.5 to €2, and then to €2.40 in 2022. But also, for instance, I mentioned from 2016, also in 2015, they were paying 77 cents. So they had almost more than 100% hike in 2016. So it's the nice thing is, at least in the last 10 years, it didn't cut the dividend. I didn't trail it longer back. It might be that it's 20 years or not. But you get it at the moment for 2.96% dividend yield at a payout ratio of 19%. So this sounds really unreal, but it is because the price to earnings is 6.5 at the moment. But they have a 5-year compound annual growth rate for the dividend of 10%. So with that being said, I feel like I need to do a deeper analysis on this. I like their business, and at a PE of 6.5, it makes me a little bit skeptical, like what's going on here? So if there's a listener that has studied Hornbach more, please ping me and let me know. Tag me on Twitter. Please let me know on Facebook. Might save me some work. But it definitely has my curiosity.
Yeah, you have to remember these types of companies, Home Depots, high inflation, and then we've come off the back of, we've had supply chain issues and the cost associated with shipping, and it's always going to affect these. So it's kind of a tough macro environment for this type of company, but it's definitely interesting that they haven't cut the dividend in 10 or so years. I always think though 30% dividend policy is too low. I always think that's too low. Give it 30 to 50. Give yourself some wiggle room. I mean, they can afford to do it. But no, interesting pick, and I'm happy you didn't go with the obvious alliance.
So tell me, what's your next one?
The next one that I chose was Deutsche Post, which was quite interesting for me because I never knew that these are basically DHL. You see the DHL vans all over the place. They're even here in Little Old Ireland. And I never made the connection that it was Deutsche Post. So that was quite interesting. But for those that don't know, maybe they're listening in Ireland like me, Deutsche Post, also known as DHL Group, are a multinational courier delivery service, pretty much like UPS in the United States. They have a couple of different operating divisions: DHL Express, which I'm aware of. They have a supply chain and e-commerce, which is something that they're really trying to push, and I think that's where they see some growth. They operate, which I think is crazy, but they operate in over 220 countries worldwide, so they really are a global company. So they do challenge the likes of UPS there. So what I did like about them actually is their dividend policy is quite clear. They're paying out 40 to 60% in net profits as a general rule, and that's something that they stick to over the last. Unlike you, I went back 10 years, no further, and they literally stick to within that range, and they have increased or kept it steady within the last 10 years. Looking at their forward PE ratio, it's trading in around 13. But if I look at UPS, which is United Parcel Service, they're trading closer to 17. So you can see there's probably a little bit more value on Deutsche Post. There's also a higher starting yield. We have close to 4%, whereas UPS is 3.5, and the dividend growth is actually quite strong as well. Looking at an annualized 5-year dividend growth of 11.3 and a 10-year of 9.90, and they had a huge increase last year as well. What I can see from the revenue is that it's growing quite steadily, and then we see a rapid increase in 2021, and they're expected to post around 94 billion. I think the 9th of March is their annual report. While that has gone up rapidly, so has debt. So that's the one thing that I would look at. See, I don't really understand why I didn't look too in depth, but I do know they're making lots of acquisitions. They're doing lots of deals. I seen one with a Polish courier as well. So they're doing a deal to break into Poland or to expand their territory there. So something to keep an eye on. But in terms of cash flow and earnings, which they tell you, earnings is what they use as your dividend metric. So it's important to watch that here. But that has been growing quite nicely. And I have to say, actually, I was flicking through the annual report, and it is a pleasure to read. Actually, I was saying it to you before the show, reading through it, they give clear calculations of everything that they use. Everything is transparent. From what I've seen, there was no real bullshit. Everything was to the point, but it was laid out really well. So one of the nicer ones, but an interesting pick. I'm always hesitant with postal services, but I think these are probably trying to be a little bit more than that, and they're really trying to get into the digitalization a lot more and automation, particularly in e-commerce. So it's interesting to see, but a solid history, solid dividend history. They've been around for, as I said, since the 1800s, even longer, I think. And it's a good German company.
Nice one. Yeah, so what you mentioned about maybe Hornbach, I have this a little bit with Deutsche Post, that it's really hard for me to invest in these kinds of postal services or package delivery companies. Really thin margins. There's only one company in the world that I could invest in this case is UPS, because they seem to be really excellent on this, but I can't even invest in FedEx. I looked at it several times. So I see the brand. They drive a lot around here, the buses. They actually are one of the service providers for the packages they deliver to my door. It's just a really difficult business, I think, to operate in. And that makes it maybe even more astonishing that they've been doing so well with the dividend here. But tough one for me, tough one.
Margins was a good one to bring up, actually, because I had a note to bring that up.
Yeah.
They are razor thin. You're looking at 17%, whereas UPS are nearly double that. They're up around 30, 20, 29. So they are operating at a tight level, and it doesn't take a lot to see these go off course. But I mean, the brand is there, and as a European brand, I think it's quite strong. DHL, as you said, is everybody knows that yellow van with the red.
Yeah. Good. So then the next one is another small cap from me, and it is Cancom SE, ticker symbol COK, C-O-K, not the other one. It's a small cap, but it popped up on my screen here, right? So again, I didn't do a deep analysis, but what I liked about it, and now I see where I made the mistake with Hornbach, because it's actually Cancom that has the 1.3 billion. But look, it's a German provider of IT infrastructure and services, and it has two big business segments: cloud solutions and IT solutions. And it's founded in 1992, headquartered in Munich, and has about 4,000 employees. In the latest report, it was around 3,700. So it is a small market cap, in my opinion. So investors always should be aware about that, because there might be a little bit less liquidity at times when it's needed. And also they are covered less by analysts. Yeah, so that's, I think, important to know. But for me, it's really a actually it's a really straightforward company. Anyone who works in IT understands their business model. So they do some consulting, architecture, system integration. They resell also hardware and software, and then with, of course, the cloud movement, they're also moving a lot to the cloud, and that's also where their growth strategy is at the moment. As an example, the revenue from IT solutions was about 1 billion in 2021, and 238 million in cloud solutions. What is nice is that 50% of their revenue is recurring. Yeah, and this is really important in these kinds of businesses. So their revenue has been growing over the last decade with about 11%, which is a really good growth. You cannot say this from a lot of companies. Their EBITDA has been growing with 17%, and they have an EBITDA margin of around 10%. What I also like is that they really invest in their people, because 5% of their profit goes to training, is invested in training. And they also donate 0.5% of their profit as well, towards charities and such. If you look at really the biggest business that is growing, or let's say like that, in the first 9 months, revenue was, by the way, down by 1% approximately, let's say like that, but their cloud solutions were growing 21%. So you could see that in the normal IT solutions, the decline of, let's say, 40 million was totally covered by a 5 times smaller business unit, which was making up for this 40 million. And this tells me that cloud solutions are really quickly growing, and if they continue to grow at this one, it might become a really meaningful business in 2-3 years down the road. Their forecast looks good, a little bit lower than 2021 for the entire year of 2022. But maybe this is where the interesting fact comes. It's trading at a share price of €32. The dividend is €1. However, their payout is 85%. So they have a high payout. So that's probably good to know. But the dividend yield of 3% and a 5-year dividend growth rate annualized of 31%. So the company still feels a little bit on the high end in the price, because their price to earnings is a 31, which is, of course, 5 times more than what I mentioned about Hornbach. So all in all, I think it's really an interesting company. They have a long, at least already, let's say for the last decade, a really nice dividend growth. I believe they were already, for instance, let's say like this. I believe in 2010, they were paying 0.08 per share. Then in 2015 to 2017, 25 euro cents per share, and now €1. So let's say in the last 5 years, it went 4 times higher than it used to be. So their growth is the dividend growth has been good, but at the cost of the payout ratio. So let's see what the annual results will say anytime soon, and whether this will be in a better position.
Yeah, nice one. The payout ratio is a little bit high, but yeah, it's interesting company out there. My last pick. Now I'll be honest. Okay, if I was to run my actual real screeners, this would never really pass it, I don't think. But on my loose screeners, it actually looks like a little interesting company. It's called Heidelberg Cement. And I think you'll get from the name what they do. They're basically a building company that sells cement, aggregates, and ready-mix concretes. And it always surprises me that companies like this, I mean, I find this a company that on the surface seems like it's easy to replicate. But these guys are in 60 countries worldwide and generating nearly 20 billion in revenue. I mean, I find that fascinating that you could do it from such a company. As I said, it's a really simple business model. They pre-made cement, aggregates, not pre-made cement. That's pretty much everything that they do. What I will say is that their dividend history, although the annualized growth rate was strong, which is why they passed my screener, they have cut the dividend. So anytime that there's a downturn, so you can see 2020 with the coronavirus, dividend cut. When we had the financial crisis, dividend cut. I would expect the same if we hit this recession that people are predicting. I would expect them to cut the dividend again. But what they do is they do grow back even quicker straight after. So as soon as they return to growth, they will pay back that dividend. So I would actually be more interested in these after a dividend growth when we're in the middle of a recession on the way out of it, because that's when these guys will start to be a little bit more interesting. I was trying to find some growth drivers. I'm always skeptical around companies like this. How do they grow? What is their growth? And pretty much it is by expanding. So as I said, they're in 60 countries. They try and expand that to more countries. That's where they go. They do talk about innovation and trying to, try to make new materials, but how much innovation can you do in cement? I don't know.
Yeah.
But in terms of numbers, I mean, the revenue has been quite steady for the last 5 years. You're looking at 2017, it was 17 billion. It's now 19, 20 billion expected this year. Free cash flow is a little bit choppy. Their debt levels is quite manageable, actually. And their earnings per share is steadily going up. So on paper, it's not too bad. It's just that dividend history I don't like, and I would 100% expect these to cut in shape of a recession. So any economic fears, I would not invest in a company like this. But with a 3.79% starting yield and a 5 year annualized growth rate of 8.45, you get a decent return from these guys.
Nice one. Nice pick. And, sometimes these boring businesses can do really well. I believe you have one in Ireland as well. Is it CRH or something like that?
CRH, yeah, building materials.
Exactly. Yeah. So nice one. Nice. And, there's so much sand in the desert. So this is kind of like a business that can last for a very long time. Very long time.
I mean, you'll always need cement. I think you will. You need to build roads. You need to build houses, unless they come up with something completely different. But I just find it really strange how you can't have a company in each. Like, why doesn't Ireland or England have their own company doing this? Or like, how are they how are they generating 20 billion in revenue from Germany?
Yeah.
It's crazy.
Well, okay, then let's go to the final company of today, and I won't spend too much time on it. But how can we have a show about German dividend stocks without having the GOAT, the greatest of all times, Munich Re? Come on. We're talking here about, what is it, 52 years without a dividend cut. Yeah, so mainly growth, sometimes a flat year, like I believe in 2019 or 2020. It needs to be in here, right? So for the people that don't know Munich Re, it's in the business of reinsurance. They have 5 segments, let's say on a high level: property casualty reinsurance, life and health reinsurance, and then they have their ergo business with life and health, property casualty as well, and international. Together, they make about 67 billion. That's the expectation for 2022. The ergo business is expected to make around 19 billion, and the reinsurance business around 48 billion. Like I said, the company has been growing dividends for 52 years. The first 9 months looked pretty good, I would say. And we can see that in the share price, because the share price currently is a whopping 320 euros. And we were talking about the show when we did the podcast 2 years ago on Munich Re, I believe, whole show analysis. It was around 170 euro at the time. So it doubled since then for such a boring business in the end. A lot of this came from multiple expansion, because insurance stocks were just really trading at a low valuation before the whole inflation cycle and the interest rate hikes started to happen. I did a video about it at the start of last year. Like, if there's one sector undervalued, it's insurance. I can see it now with all the insurance stocks that blew up. So I should have doubled down more into insurance at the time. But the dividend at the moment of 11 euros, so we will soon know what it will be more. They're anticipating in general like a 5% long-term dividend growth. So maybe it will be like, 11.50 or 12 euro, because they are doing pretty well at the moment. Payout ratio 55%. You still can get it for a dividend yield of 3.4% with a 5-year CAGR of 5%. Price to earnings at the moment 16. Not too expensive, but I do think that you can get insurance companies typically for like an 11 or a 12 PE over time. So I think you do pay a bit more for it than needed. But on the other end, if you're purely looking at dividend growth, and you look at passive income investing. Hey, take the 3.4%, let's say, and you know it will, with a company like Munich Re, will just grow unless there's really an apocalypse or really a black swan event. But 52 years is not something that they will likely give up anytime soon.
No. And I really want to go back and listen to that episode of the podcast, because I remember we were both bullish on them. I can't remember the price point I had set at the, maybe I said it in the podcast, but I know I didn't buy them at the time, and I've been kicking myself ever since. Really top class company. And as you said, you were bullish at the time on all insurance stocks, but I think this was your number one pick at the time. And it's done quite well. So I'm not surprised. I didn't think we'd get through a show without naming one of the big guns. I mean, I think I said it. If we were to really pick, Allianz would have been there. Siemens would have been there. Even Siemens Healthineers probably would have been up there. But it's nice to give some variety sometimes as well.
Yeah, so maybe full disclosure to everyone. I'm long Munich Re, I'm long Allianz, I'm long Siemens, I'm long BASF, and I will really pay close attention to the upcoming earnings report of Hornbach to see how they're performing and whether I want to initiate a small position or not.
Yes. Okay, we have a portfolio review from Jason, who sent in his portfolio of about 30 stocks. I'll maybe run through the top 5 or 6 and then maybe get your thoughts on it. So the first position is Enbridge, ticker symbol ENB. Second is T. Rowe Price, ticker symbol TRO. Then we've got Kinder Morgan, ticker symbol KMI. And then to make up the top 5, ABBV, ticker ABBV. What are your thoughts?
I think it's a really nice portfolio. I think there are a lot of high yield is there in the top 10. Like, I mean, not like 6-7%, but like 3% plus. Yeah. I'm not such a fan of Kinder Morgan. I still remember that the CEO said in 2016 or 2015, like, oh, the dividend is safe, and look at me, how great I am with my dividend policy. And our business is like a toll gate model. We put in the pipelines, and the oil and the gas is something that will flow, and we anyway ask a price. And then the 2016 oil crisis happened, and they had to cut the dividend. So he lost my trust. So I wouldn't invest in Kinder Morgan for that reason anymore. But the other ones look very solid companies. I'm just missing a little bit more of the growth companies. There's heavy in energy in his top 10 of how is it, actual income. That's, I guess, similar to me, to be fair. But I'm missing here a little bit the higher growth companies. Anyway, if I look into the entire list, I can see them a little bit more towards the bottom of the list. So maybe it's just building them up. And I would say, yeah, probably good to continue focusing a little bit on that one, at least that you don't miss out on the opportunities.
Yeah, no, I'd agree. I was thinking it was very, very heavy in energy, which I'm not quite surprised. There's a nice mix overall. I mean, we've got some good growth companies here. We've got Texas Instruments there. We've got APD. We've got Microsoft. Apple's in there. So I do like the mix he has. He's got companies like Procter & Gamble, Leggett & Pratt are in there. Bristol Myers are in there. McDonald's are in there as well. The only thing I see, he's got one REIT as well, which is Realty Income. Maybe that's a sector that you could maybe look to diversify in more. But I think it's a really, really strong portfolio. You're right; it's a lot more higher yielding towards the top end, which is adding a lot more to your annual income. Energy might be hitting. Might be close to a top of a cycle over the next year or two, so it might be worth trying to build out some of the higher growth. But I think overall, I think it's a pretty good portfolio. There's 33 companies there. There's maybe 1 or 2 that I might not have myself. Maybe US Bancorp might be one, but I think overall it's a decent portfolio. Yeah,
definitely.
Good job. Okay, some listeners' questions. Dazzy Mike, what percentage of your portfolios is invested in European stocks and what percentage in US stocks?
Yeah, that's a really, really interesting question because it's not easy to answer. But what I can tell you is more like from, I guess from, is it from a currency point of view, I should say it?
Yeah.
So I think it is around 50%, maybe 52, 48% that I have in euro. No, in European stocks, which includes Britland, sorry, United Kingdom.
Cool. I've got 48.2% in US and 40.5 in EU, and then the rest of it is made up in CEFs, and I have US growth there as well. So it's probably closer to 50% US and about 40% in European
Nice,
stocks.
nice. Yeah.
MH79. Do you have an opinion on Talanx? I don't know what the ticker symbol is for that. They have a 50% stake in Hanover RE and increased the dividend by 25% this year.
Yeah, I looked into it and it just doesn't pass my screener criteria. So that's why I'm already not so interested into it.
Yeah, I think the ticker symbol is TLX, and it's also in the insurance sector. So it's competing with the likes of Munich RE and Allianz, which we've discussed. If I was to go into insurance, those are the two companies I'd be looking at, and not Talanx. To be fair, as you said,
Yeah.
it didn't pass my loose screener, and it didn't pass probably a little bit more in depth screener either. So it wouldn't be on my watch list. Tuck Umbo has asked us the HLAG dividend increase and thoughts on Colgate. Your thoughts on Colgate.
Yeah. So maybe the Hapag-Lloyd dividend increase, I think we're talking about shipping. So this is a business that business line that I totally am not interested in. I think you have been having a laugh affair with Zim when you were doing the option trading. So Tokumbo, I can't say anything meaningful about that because I'm not interested in that kind of business. Then the second one, Colgate Palmolive. Yeah, that's a really good company generally, right? So I mean, it's been always a bit on my watch list, but it's one of those companies that always feels a bit expensive. But I'm using their products at home, Colgate, or Almex in that case, but I don't know if that's also from Colgate Palmolive. Never checked it actually. So Colgate definitely at the right price. I would like to have it, but at this moment in time, not yet.
So I looked up Hapag-Lloyd, ticker symbol HLAG. And what I see, I don't know if this is correct. This again, I'm using Kyphon here. Annualized growth rate over 3 years, 515%. 1 year, 900%. The dividend is about €35. If it's anything like ZIM, which I tried the dividend capture on, yes, you'll get €35 into your pocket, but the share price dropped that and a little bit more as well. So you lose it somewhere along the line. But that is a huge amount. It gives them about a 13% dividend yield as well. But like EDGI, I'm not familiar with the company, what they do. So not for me. Lars has asked us, what do you need to see in Fresenius to make it a screaming buy?
Good management and return to growth.
Yeah, I mean, it's a management there, and the business is really complicated as well, isn't it? They're just split into all different segments, and it's sometimes it's hard to get a grasp on it. I did know we got something in Facebook management there. I read it. I didn't really understand what they were trying to say. I think they're saying they're going to split the businesses and try and simplify the portfolio a little bit, but I really think management need to step up here.
Yeah, it was a really difficult language, so I asked someone to translate it for me, and they said like, they're shifting kind of the ownership structure into stock structure or something like that, so that they don't need to put the entire Fresenius medical care anymore in there and consume them in their annual results, something like that, so that we get a more cleaner insight on the real numbers of Fresenius. So look, management needs to be better. It's a shame. It's an iconic company. I really like the history of this company, but I couldn't keep it in my portfolio with how it's being managed.
Yeah, it is management. Like from a loose screener, it would have passed my screener earlier with the CAGRs and the dividend yield. It also would pass my initial screener as well in terms of revenue growth, free cash flow growth, earnings per share growth, and even their debt level is management. So it has the hallmarks of it. If management can get their act together, they could really grow this company. It's in a really good market. We know they're in healthcare. They cover a wide base within the healthcare segment. So there's potential there, but I just think management need to simplify the business, make it easier for investors to understand what they're actually investing in, and try and give us a little bit more growth. And I'll be there. I think I thought I sold them. I didn't. I have an order in to sell them. They didn't reach the price. I think I still own like 10 shares of this company. So, but let's see how they go. But for me to invest in these again and to buy more shares, something has to change with management.
Yeah.
RZMF, what do you think about Bayer now that CEO is now finally gone?
Well, first of all, I'm so happy that this was Werner Baumann. I'm so happy that he's gone. Yeah, I don't even know how to call it, but it's one of the worst CEOs that I've had in my portfolio. Maybe John Stinky is even worse from AT&T, maybe still. But if you put, it would definitely be in the top 3. I mean, he was at the time there when they were, I said, doing the Monsanto deal. Was it 65 billion or something like that? Now, so many write-offs and how is it, reservations for the liability and the lawsuits around Roundup, still not settled. Couldn't get a proper deal, neither by the Supreme Court. It's all in the hands of juries. They have a plan, but this plan is not rock solid. So, and that's also the issue now with the new CEO, right? Will the new CEO be able to fix this? Yeah, that's the real question, because as long as this Monsanto issue with Roundup is not settled, it's hard to invest in Bayer. It is really like a heavy weight on the shoulders of this giant. And it's a pity because their pharma business is doing pretty well. Their food business is doing pretty well. It's just this Roundup lawsuit.
Yeah, I get the excitement with the CEO going. I understand, but my initial reaction was, it doesn't mean I want to buy them yet. It actually, like, it might be a good time because they're so depressed, but it is a risk because Monsanto is still there. What can the CEO do with it? I don't know. We don't know yet, but it's certainly a huge challenge, and probably one he's going into, knowing that he has to sort this out. But I can't. I don't think I could take that risk until we start to see some bit of light at the end of the tunnel. I think that's, and by that time it might be too late. The share price might be after catching up.
Yeah, and what is interesting, they chose an American CEO, so maybe this is also a reason. It might help actually here with the how is it, American regulators.
Yeah, cool. Ivan Mitchell, do you think that Berkshire Hathaway will ever pay a dividend?
Not as long as Buffett is alive.
That was going to be exactly my answer, exact same one. For as long as Buffett is around, they won't. I can see them paying a dividend when he's gone.
Yeah, and which might be any day. Yeah, he's an old guy, right? He's in the 90s.
Oh, yeah. Very morbid, but we'll move on. Bass Erlings, do you have any opinions about fund share, UCITS, Belgers? It's a dividend fund. Anyway.
The Beleggers Belangen dividend fund. So
yeah,
was probably good to know. Beleggers Belangen is like, I remember it at least from the magazines about investing. So it's kind of looking after Dutch investors, and they create their own dividend fund. They have a total expense ratio of 1%, which is quite high. But honestly, Bas, I really need to look into it. So I want to withhold from on my opinion right now, but it's nice actually that they created their own fund. I'm a bit surprised, so which is a positive surprise. So I'll look into it and maybe on Twitter let you know what I think about it. But generally, when I look at ETFs, what I want to see is dividend growth. Yeah, because I invest for growing dividends. So if dividend ETFs are not paying me a growing dividend, then yeah, it can have everything in the name, but I'm not interested then.
Exactly. It's no point in having it in the name. It needs to do it in practice. But I'm like you. I can't even pronounce it, let alone invest in it. So I let you do the research on this one. Jacob, what are your thoughts on Allianz? I think we gave some of them above. But
yeah, good business. I think around fair value. But I'm not buying now at these prices. I would wait for another dip again.
Yeah. Matt Barker has said, obviously, we're all here for dividends, but it'd be great to discuss share buybacks. Maybe a bit of a basic explanation of them.
Oh, yeah. Effectively, they're buying back their own shares, right? To reduce the share count so that the earnings per share will increase. This is really beneficial to management because they often get paid in their compensation with options. So if they are able to buy back shares, then they are growing the earnings per share. And with that, they have more chance on getting their options exercised, which will bring the average CEO several millions with a little bit of luck. So I think that's the whole incentive for management to buy back shares. Then there is also generally a tax advantage compared to dividends. So that might also be a pro for doing buybacks. The issue that I just have is with buybacks, it is kind of timing. There are companies that buy back shares continuously, and they have been, if you then take, for instance, the dividends plus the buybacks, there are companies, just quite some of the big companies, that spend more than their free cash flow with this. And we just spoke about Pepsi. Pepsi is one of those. So what they are really doing is they are leveraging up to buy back the shares. So they are borrowing money to buy back shares, and they were doing that, of course, massively at a zero interest environment, thinking like, we'll buy back if we need to pay, let's say, a 4% dividend on every share, and we pay 0% to the bank. Hey, let's borrow the money and cancel those 4% yield that we need to pay every time, right? As well. So I understand that, but it's really kind of a yield play or an interest rate arbitrage. But I don't like that they've been massively buying back shares at the cost of a weaker balance sheet, and they need stronger balance sheets in a time of crisis. And you know what happens then? They will cut the dividend. So yeah, and you need to buy shares when you think your own company is undervalued, not like automatically. They shouldn't dollar cost average like that with themselves.
Yeah, I mean, a lot of companies use it as a way to manipulate their earnings per share and show that number is growing when it's not organically growing. It's growing because you're reducing the share count. But I'm not opposed to share buybacks. There's a time and a place for them. I just like you, I feel like a strong balance sheet and value are really important when it comes
for me, for instance, HPQ buying back shares at a 4 or 5 PE. I mean,
makes sense.
Then you go to the bank. Yeah, then you go to the bank to borrow money as long as you stay within the healthy balance sheet line. Microsoft is doing it really nicely out of the free cash flow. So although it's been a bit on the expensive side, but at least that they're still investing, so they're just so cash rich that they're doing at least something with it, so they can get away with it. But it's one of those exceptions where I approve kind of this automatic buying back.
Cool. Matthias has asked us, is INGR ticker symbol EIN3 the German Stanley Black & Decker? Is it a good investment considering your metrics and strategy?
So first of all, INGR, that sounds like a hell, like from the devil. Imagine buying such kind of equipment that is called hell in your hands and holding it. I don't know. It doesn't feel well. I would be afraid cutting off my fingers or something like that. But look, a PE ratio of 9.5 and a dividend yield of 1.5%. So just the dividend yield doesn't make it attractive for me enough. And the reason for that is also it has a market cap of 630 million, which is again a small cap. So I expect a bit more there. That's the reason why I'm not so much interested in this to even look at it further, because it's not passing my screener criteria. But Matthias, please, if you feel like this is the answer you don't buy and you have a strong investment case and a strong bull case, I'm interested. So feel free to let me know.
Cool. And then we have two questions to finish from Simon. The first one is, when the glorious day arrives that you are financially free, do you think you will actually be able to stop dividend investing and start burning through the dividends as you cover your cost of living?
Yeah, really interesting here. Yes, no. I think, for instance, I would still be earning some money as a side hustle. Because from one side, or maybe I even keep working, and maybe just to less extent, and I would just use all that money to continue dividend investing. It's a passion, it's a hobby, so I can't see myself stopping, but it would make all the difference how much money I have at my disposal in the end. I want to live off the dividends, so that will have a priority, and everything that's left will be reinvested in my portfolio. That's how I look at it.
Yeah. And if my long-term plan with my wife comes to fruition, it won't be just dividend income. There'll obviously be maybe property as well. There'll be other forms of income to help supplement that. So yeah, it's good. It's a good question. I'll worry about that when I get there. But at the moment, I'm just focused on building my income as much as possible, and we'll see where we end up. But it's mad though, isn't it? It'd be hard to just shut off. You're so used to it, maybe 10, 15, 20 years investing every month. You get to a point, it would be hard to actually go, oh, I'm not doing this anymore. Anyway, the second question is, many companies discussed on the show are very mature. He appreciates the sense of security associated with this, but he worries about the growth part. So it's dividend growth investing. Maybe he wants a discussion around focused on smaller companies that maybe have patchy but growing dividends over time. So the UK is probably prime example for this. They've got a lot of small to medium cap companies that pay dividends quite good in growing them, but can be patchy. What are your thoughts on this?
Well, yeah, patchy dividends I typically exclude for the simple reason that just because of the former question, imagine you're living off your dividends and you have all these patchy dividend stocks in there, and suddenly you lose 20% of your income. And hey, darling, take an Uber, take your car and go ride people around in your Uber to compensate the missing 20%. So that's not how I envision it. So that's why they often drop off for me. But it sounds like we need the Kleine Kapitalist again on our show, and also to satisfy Simon a little bit, because he is the master of all these like low yield, high growth companies with sometimes a patchy dividend. I think, Simon, that will resonate a lot with you. But I also think that today with the two stocks that I shared, that's an example. So we will try to, and because we mentioned that ourselves already, we will try to look a little bit out for other stocks as well that we haven't discussed so much. The only, the only notion here is probably good to know is that we don't have a lot of knowledge on them, so we can't really go further than the initial screening and the initial analysis, and it would take us much more time to then do a deep dive. So like today, you will hear us more talking then on the screener level, the initial analysis level. But I hope that actually inspired you also a little bit today. And one of those examples is, of course, Hornbach.
Yeah, I can understand the question, because if you look at the way my screener was built for today's stocks, I had yield and 5-year CAGR. In theory, you could have a company that paid a good dividend in year one, cut it in year two, and grew it 3, 4, and 5, and have a decent CAGR over the 5 years. So I can see how it works in theory. And we also saw it, I think, was a public storage public storage increased to 50%, even though it's the first time since 2016, and now they have a decent 8% CAGR based on it. So I understand the concept, and on paper it might make sense. But then if I think about it, when I'm in that scenario and that company cuts their dividend, they're cutting it for a reason. First of all, they're in trouble that year. You don't know if it's going to return next year, the year after. Are they going to return it 10 years later? And that's my problem with that. I know the UK is quite strong with small caps, and I think we did an actual show around small cap companies with Russ, if I remember correctly. And I think the UK has some really good companies. I think it's a great discussion. It's probably one for Twitter, or not for Twitter, for Facebook to get involved in and really, really discuss this. But I think my problem would be, although it makes sense on paper to look at the growth rate and focus on the growth part, cutting the dividend psychologically, I don't know when it's going to come back, which would likely lead me to sell the company. And then I'd end up missing, if they bring it back again, I'll end up missing, like something similar to Tangar. I missed out on that. They cut the dividend, I sold, they increased the dividend again. So it's more psychology, but it makes sense, and I think it would be a good discussion.
Yeah, and if you think about the dividend and then the growth part, that for me makes more a case for low yielders like L'Oreal. Yeah, that have a low yield like 1.5%, but are really in a rapid growth stage at the moment.
Yeah, I've been really thinking about this the last week or two, and I've done a column in my tracker for that as well, just yield and growth. So I want to be making about 8 to 10% a year. That's my goal. And whether that's from high yield, low growth, or low yield, high growth, that's my aim. But it's a good discussion, I think, to have.
Definitely. Hey, with that, we're coming to the end of the show, Derek. Thank you so much again, and thank you also to all the listeners for all these questions. And yeah, let us also know whether you enjoy this, like taking a country once in a while. So we are aiming to do this once a month. So now we did Germany. Maybe next time we can do Netherlands, France, or Austria, or whatever company also you would like us to think, Sweden, Norway. Let us know. We hope you enjoyed it, and see you next time.
See you all soon. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.